Hello and welcome back. It is June 14th and we are here to talk about mortgage rates. Woohoo! So yesterday, remember we talked about a couple of things that were coming up today, the producer price index, and then also we talked about Mr. Bernanke speaking, the president of the Federal, or the chairman of the Federal Reserve, speaking today, and he was going to speak about the U.S. debt limit and whether or not we are going to reach it and what would happen, and if we did. So we spoke yesterday about the effects that reaching our debt limit and we can't legally go any higher. We would be out of money to pay our obligations. What effect that would have on the stock market, the bond and treasury market, and then the securitization market, and then in turn your mortgage interest rates. We talked about how that would have an effect negatively on interest rates, and when Mr. Bernanke spoke today, he reiterated that. A couple of quotes from his speech today. He says, even a short suspension of payments on principal or interest on the Treasury's debt obligations could have severe disruptions in the financial markets and the payment system. It would create fundamental doubts about the creditworthiness of the United States and damage the special role of the dollar and Treasury securities in the global markets in the long term. That is news that the market did not like, and they're commenced to sell off in Treasuries right during his speech, and then it continued after his speech. So again, we started the day with the producer price index. It came in up 0.2% as opposed to what we thought was up 0.8%. So not as bad, less bad news, but still the markets looked at that as a reason to sell off, and we started the day lower, and we continued in a trend for most of the day until Mr. Bernanke spoke, and then bonds sold off again. So right now we're within a range of about 3.8 to 3.1 in the 10-year Treasury. Staying within that range is good. And we've dropped about 21/30 seconds in the Fannie Mae 4.0% mortgage-backed security. So I want to show you a couple of charts here. First, the Fannie Mae 4.0, a 3-month chart on the Fannie Mae 4.0 mortgage-backed security. I want you to notice the inflection points here. We're in a bear trend, which means we're moving up, and then but every upswing is matched with a downswing, and what you want to see is the upswing is getting a little higher and the downswing is getting a little higher as well, and that's what's moving us up right now. So last week we got up as high as 101.18 on the Fannie Mae 4.0 mortgage-backed security, and right now we're at about 100.07 or 107.30 seconds. So we're in a downturn right now, but long term I think it's still bearish, or bullish, excuse me, which means that interest rates are still set to do fine in the long term. I want you to also take a look at the 10-year Treasury. So the 10-year Treasury has been moving down. It moves inversely to the mortgage-backed security market, because here we're tracking the yield, whereas with the mortgage-backed security we're tracking the price. So this downturn in yield from April, you can see this large slide has been what has been driving our mortgage interest rates down, and really we're just testing that. And as you can see, again, they're upswings in the midst of our slide down, and in my opinion this is another upswing in the midst of our slide down, as you see this resistance holding at 3.1 or so. So yeah, that's what I'm looking at. That's some of the reasons for my optimism. If you look at it differently, if you have a different opinion, give me a call or shoot me an email or comment down below. So short term, bad news. Hopefully your interest rate was locked. If it's not, it needs to be locked today. This was much more of a drop-off in the market than anybody had anticipated, but we did anticipate short-term drop-offs, which is why we said if you're closing the next 7 to 10 days, it would behoove you to have been locked. If you're closing in the longer term, it's fine to float. Any interest rate rally or bond rally or mortgage security rally is going to have setbacks to test that rally, and those are healthy. So we're in one of those setbacks right now. Because we're holding our range between 3.8 and 3.1, long term that looks good for a sustained rally. The problem is that interest rates go down much less quickly than they go up, or said more correctly, interest rates rise much more quickly than they fall. Big, it's your interest rate and your closing costs. It's really a difference of an 1/8 or a 1/4% in extra closing cost money. Your interest rate should be the same, but it is a little bit worse than yesterday. So hopefully your loan officer is on the ball and has locked you guys today, if they haven't locked you before, and if you're closing within the next, now I would say 10 to 15 days, because of the how quickly the market went down today. It will work its way back up, in my opinion. That's not a fact, it's my opinion that it will work its way back up, but it will take a little bit. So alright, that's our day for today. Interest rates got a little worse today due to Mr. Bernanke talking about the U.S. Treasury debt ceiling and what would happen if we don't raise the ceiling before August 2nd, which is the day in which we would reach that ceiling. if we were not to raise it. And then the producer price index came in a little better than expected, and that helped the stock market. Hopefully you guys find this news valuable. If you have any questions about what's going on in the market, you want to talk about it, you want to see if it's a smart time for you to buy or for you to refinance, all my contact information is down here, my phone number. Go on over to Mortgage Matters at facebook.com/mymortgagematters. You can find me on Twitter. The handle's right down there. And then also at lawmortgagesolutions.com. Give me a call anytime, shoot me an email, anything. And please forward this on to your friends, put it on your Facebook, put it on your Twitter, tweet it out. It's important information about what's going on in the mortgage rate industry that could save people money or cost them money for the next 30 years of their life. All right, I'll talk to you soon, and I'll see you tomorrow.